Welcome to the Trader24 studios for your daily financial update on the global markets. Following the U.S. Senate's decision the day before yesterday to fund the technological sector with $280 billion and with a momentum gained from the reassuring words of Fed Chairman Jerome Powell, investors remain optimistic, turning a deaf ear to the dangerous announcement of for the second time in a row, contraction of the U.S. GDP. In fact, it came in at a higher than expected minus 0.9% for the second quarter, which followed the minus 1.6% of the first quarter. The U.S. now, apart from officially having a benchmark interest rate of 2.25 to 2.50% after the second consecutive record increase of 75 basis points, is also in recession, at least at a technical level. This is because it is defined when an economy records a decline in GDP growth for the second consecutive quarter, which is exactly what happened yesterday. The problematic of the recessionary vice is justified by the fact that expectations for recovery in the next two quarters of 2022 are minimal, at least according to both the international firms, with the aggravating reports and the IMF, which the day before yesterday brought the figure of 3.2% after the revision from the already reduced 3.6% in global economic growth, with the Chinese economy taking the biggest jolt at 3.3% instead of 4.4%. The markets, although they see the probably anticipated U.S. interest rate at pre-pandemic levels and at 14-year highs at the same time as the stagflation cloud is very close, nevertheless remain calm. The dollar has seen 20-year highs with a persistent appreciation of recent months. Commodities continue their mismatch of dangerously high energy costs and plummeting agricultural commodities in the shadow of an endless war. The freight market remains depressed, reflecting the possibility of a slowdown in economic growth, and the government bond market is trying to find its footing in a time of investment uncertainty. You're watching the Trader24 Daily Global Market Overview. Let's take a closer look at the situation. On Wall Street, buyers continued to party after the Federal Reserve's announcement, with the major indices moving higher, even turning positive in a session that started with extended losses. High trading activity and closing at the highs of the day gave optimism points. S&P 500, Dow Jones, and Nasdaq closed with gains of more than 1%. The New York Stock Exchange Index closed positive at plus 1.12% and firmly above the 15,000 points that had been fluctuating around for weeks. The small cap was strongly affected, with Russell 2000 closing at plus 1.34%, while the VIX Risk Index lost another 3.92 percentage points, already counting 21% in July. All S&P sectors closed positive, apart from a misstep in telecom with a minus 0.74%, with real estate at plus 3.70% and utilities at 3.53%, recording the largest positive signs. And respectively, American Tower at plus 4.11% and Amarin at plus 2.99%, outperforming all their sectors. The main positive protagonists in large cap were Constellation with a plus 9.06% and Etsy with a plus 9.42%, while in the small cap, Sunrun with a plus 29.97% and Plug with a plus 25.9%, while 58 out of 102 tech stocks saw new weekly highs. Finally, in the industrial Dow Jones, just 5 out of 30 closed in negative territory, with all eyes certainly on Nike, which outperformed with a plus 4.05% gain to $112. In the pre-market now, most listed companies are moving in positive territory, with the Chicago futures giving a bullish opening. And despite the unexpected optimism on Wall Street, with its GDP declining for the second consecutive quarter, the Hang Seng closed in deep negative territory, losing 1.84%, with the Chinese probably taking both the recessionary wave in the US and the IMF's hellish report that revised down the country's expected economic growth rate to 3.3% instead of 4.4%. At the same time, sentiment was exacerbated by the government's announcement that there will be no new quantitative easing in the near future, followed by the vague talk of the need to achieve a growth rate of 5.5% as a hedge against the IMF's 3.3%. Japan's Nikkei saw a strong gain of 0.50%, the Topix closed unchanged, and the Australian 200 continued at month highs with fresh gains of 1%. European markets are following the pace of Wall Street, with investors turning a deaf ear to the poor macroeconomic data of the now inflated Eurozone, while the critical Italian political issue opened by Mario Draghi's resignation remains open. The biggest gains are currently seen in Hermes's shares at plus 6.97%, while Prosus at minus 3.62% and Santander with a minus 1.24% are moving heavily. In Athens Stock Exchange, Greece is moving positive with a plus 0.45% in the general and 25 large cap indices, with banking at plus 1.24%, while turnover remains extremely low for another session. At the moment, the critical level of 845 is being tested, which is the last resistance. The easing of investment fears brought buying interest in US bonds, with the US Treasury seeing a 2.68% rise in the US 10-year yield to a 6-month low. The 30-year is in the 3.05% zone, with a spread between them widening dangerously, reflecting high implied volatility. The 2-year remains 16 basis points higher than the 10-year, while in Europe, the yield on the German bond was down to 0.89%, with the spread of the Greek at 207 basis points, the Treasury at 185 basis points, and the yields at 104 basis points. Still, air prevailed in the forex market, with the almighty US dollar showing renewed bearish sentiment and the DX dollar index retreating to 106 and the last supports, while the exchange rate with the euro remains in the region of 1.02. The pound remains above 1.21, the yen depreciated heavily, seeing 132 per dollar, a 1-month low. The Canadian dollar continued to appreciate towards 0.78 US dollars at June levels, and the Swiss franc remained at 1.05 US dollars. The CEOs of the two oil giants Shell and Total Energies, Van Beurden and Pouyan, gave a strong message to the commodity markets that a reduction in oil prices in the coming months seems a distant scenario. This is because, according to the company's data, demand has not yet fully recovered, far from the pre-pandemic levels, while the stingy supply from oil producers is a burden. In this sense, all eyes are on the upcoming OPEC Plus announcements, although expectations for production growth are poor, since on the one hand, crude stocks have already been announced, which have fallen by 4.5 million barrels, and on the other, Biden came back empty-handed from his recent visit to the Middle East. In addition, there remains the interesting wide divergence between Brent and crude, with Brent now around plus $10 per barrel, which occurs when volatility is about to increase excessively. In the broader picture, the main commodity indices gained an average of 0.94%, with those of zinc at plus 3.42%, soybeans at plus 2.24%, oil at plus 1.54%, and wheat at plus 1.53%, outperforming. In agricultural commodities, wheat overtook 5-month highs of $8.2 per bushel, and soybeans rebounded from 8-month lows to $16 per bushel. Finally, in the freight market, the Baltic closed negative again by 3.1%, ahead of the risk of a severe recession in the coming period, with all individual indices, Capesize, Panamax, and Supramax showing weak behavior. In terms of economic announcements, the core U.S. personal consumption expenditure price index will be released today, with forecasts pointing to an increase at the 0.5% level. Yesterday, the U.S. GDP results for the last quarter were released, which were significantly below forecasts, moving into negative territory at the minus 0.9% level. In terms of corporate announcements, today we expect the financial results of ExxonMobil, with projected earnings per share of $3.84 and revenue of $94.97 billion, Chevron with projected earnings per share of $5.09 and revenue of $57.96 billion, and AstraZeneca with projected earnings per share of $0.7876 and revenue of $10.51 billion. Also set for today is the dividend ex-day of Citigroup with a yield of 3.90%, up 22.1% year over year, and Texas Instruments with a yield of 2.68%, up 17.16% year over year. Yesterday, financial results were announced by Apple with earnings per share of $1.2 and revenue of $82.96 billion, both above forecasts. Amazon with earnings per share of minus $0.2 and revenue of $121.23 billion with earnings per share below forecasts. And MasterCard with earnings per share of $2.56 and revenue of $5.5 billion, both above forecasts. For the third day in a row, cryptocurrencies continue to rise after Fed Chairman Jerome Powell's announcement the day before yesterday of an expected 0.75% rate hike, and despite yesterday's release of US GDP, which showed a 0.9% decline for the second consecutive quarter. Against the backdrop of these developments, Bitcoin has climbed to over $24,000 as of last night, an increase of over 4%, which it had surpassed again 10 days ago. Ethereum also rose dramatically by 5.41%, up to $1,783 sometime last night, which it had not seen since early June. Altcoins continue their upward trend as well, with the most spectacular increases being seen in Optimism at $1.63 with a plus 48.28%, Ethereum Classic at plus 31.32% at $43.31, Solana at $43.06 with a plus 9.23%, Uniswap at $8.93 with a plus 9.24%, and Polygon at $0.95 with a plus 9.78%. Meanwhile, the list of bankrupt crypto companies grew with the filing of petitions in Singapore by troubled crypto exchange ZipX for protection amid the threat of legal action from its creditors. In addition, crypto lender Voyager Digital, which had filed for Chapter 11 bankruptcy protection in a U.S. court earlier this month, was ordered by U.S. banking regulators to stop making inaccurate claims that the company was insured by the government. Thank you for joining us today. It was the Trader24 Daily Global Market Overview. Stay tuned for our next comment on the financial markets.